Watch video 09 from the workbook NISM Series 17 Retirement Advisor Certification Examination Final Feb 2024, and review the multiple choice questions and answers. 1. What is inflation risk? A. Risk that inflation will lead to higher returns. B. Risk that inflation will erode the real value of returns. C. Risk that inflation will reduce interest rates. D. Risk that inflation will increase the cost of borrowing. Answer. B. Risk that inflation will erode the real value of returns. 2. Inflation risk is highest in which type of investment? A. Equity. B. Commodities. C. Fixed return instruments. D. Real estate. Answer. C. Fixed return instruments. 3. Who is most affected by inflation risk? A. Retired persons. B. Young investors. C. Business owners. D. Government. Answer. A. Retired persons. 4. How can investors manage inflation risk? A. By investing in fixed-term deposits. B. By using tactical allocations and inflation hedging assets. C. By holding only long-term bonds. D. By reducing all investments during inflation. Answer. B. By using tactical allocations and inflation hedging assets. 5. What is default risk? A. Risk that the value of assets will decline due to market conditions. B. Risk that borrowers will not meet their debt obligations. C. Risk of low returns due to inflation. D. Risk that interest rates will fluctuate. Answer. B. Risk that borrowers will not meet their debt obligations. 6. Which type of borrower has no credit risk? A. Private companies. B. Sovereign governments. C. Municipal corporations. D. Startups. Answer. B. Sovereign governments. 7. What does a high credit rating signify? A. Higher returns for the investor. B. Lower risk of default. C. Greater market liquidity. D. Higher interest rates on the bond. Answer. B. Lower risk of default. 8. What is liquidity risk? A. Risk that an investment cannot be sold easily. B. Risk that interest rates will change. C. Risk of not receiving a fixed return. D. Risk that market prices will drop. Answer. A. Risk that an investment cannot be sold easily. 9. Which investment is subject to liquidity risk? A. Stocks. B. Corporate bonds in India. C. Government bonds. D. Mutual funds. Answer. B. Corporate bonds in India. 10. What is reinvestment risk? A. Risk of not being able to reinvest at the original rate of return. B. Risk of losing money when selling investments. C. Risk of rising inflation. D. Risk of default on loans. Answer. A. Risk of not being able to reinvest at the original rate of return. 11. Which of the following is not affected by reinvestment risk? A. Coupon-yielding bonds. B. Bank fixed deposits. C. Short-term treasury bills. D. Equity funds. Answer. B. Bank fixed deposits. 12. What does business risk refer to? A. Fluctuations in inflation. B. Volatility in interest rates. C. Risk inherent in a company's operations. D. Changes in market liquidity. Answer. C. Risk inherent in a company's operations. 13. What can help manage business risk? A. Increasing debt in a portfolio. B. Investing in competing companies. C. Holding a diversified portfolio. D. Reducing exposure to equity. Answer. C. Holding a diversified portfolio. 14. What is interest rate risk? A. Risk of inflation rising unexpectedly. B. Risk that bond prices will change due to interest rate fluctuations. C. Risk that the value of a company will fall. D. Risk of default by a borrower. Answer. B. Risk that bond prices will change due to interest rate fluctuations. 15. When interest rates rise, what happens to bond prices? A. Bond prices rise. B. Bond prices fall. C. Bond prices stay the same. D. Bond prices fluctuate randomly. Answer. B. Bond prices fall. 16. What determines the extent of interest rate risk in a bond? A. Its credit rating, B. Its yield, C. Its duration, D. Its marketability. Answer, C. Its duration. 17. Market risk refers to A. The risk of inflation affecting bond prices, B. The risk of loss due to adverse price movements, C. The risk of not finding buyers for assets, D. The risk of receiving a lower rate of return. Answer, B. The risk of loss due to adverse price movements. 18. Which investment is least likely to be affected by market risk? A. Equity, B. Bonds, C. Commodities, D. Real estate. Answer, C. Commodities. 19. Which asset class performs well during inflationary times? A. Equity, B. Commodities, C. Bonds, D. Cash. Answer, B. Commodities. 20. What is the GDP used to measure? A. Inflation rates, B. Economic growth, C. Interest rates, D. Market risk. Answer, B. Economic growth. 21. What happens during a recession? A. Economic growth speeds up, B. Sales, production, and employment slow down, C. Real estate prices boom, D. Bond prices increase significantly. Answer, B. Sales, production, and employment slow down. 22. What is inflation? A. Increase in GDP, B. Decline in bond prices, C. Increase in general level of prices, D. Growth in foreign reserves. Answer, C. Increase in general level of prices. 23. High inflation impacts which asset class negatively? A. Equity, B. Real estate, C. Commodities, D. Gold. Answer, A. Equity. 24. How does government borrowing affect the market? A. It reduces inflation, B. It pushes up market yields, C. It increases equity prices, D. It decreases bond values. Answer, B. It pushes up market yields. 25. What does a current account deficit, CAD, mean? A. The country exports more than it imports, B. The country is a net creditor, C. The country imports more than it exports, D. The country has a balanced budget. Answer, C. The country imports more than it exports. 26. What is asset allocation? A. Creating a portfolio based on short-term market trends, B. Investing in a single asset class to maximize returns, C. Diversifying investments across asset classes to manage risk, D. Avoiding risk by holding only cash investments. Answer, C. Diversifying investments across asset classes to manage risk. 27. Strategic asset allocation, SAA, focuses on A. Short-term market fluctuations, B. Long-term goals and risk preferences, C. Maximizing short-term profits, D. Market performance forecasts. Answer, B. Long-term goals and risk preferences. 28. What triggers rebalancing in strategic asset allocation, SAA? A. Changes in market conditions, B. Portfolio allocation shifting away from original proportions, C. A change in government policies, D. Sudden inflationary pressures. Answer, B. Portfolio allocation shifting away from original proportions. 29. What is tactical asset allocation, TAA? A. Long-term investment strategy, B. Rebalancing portfolio based on short-term market performances, C. A method of avoiding all risks, D. Avoiding investments in risky asset classes. Answer, B. Rebalancing portfolio based on short-term market performances. 30. What is the drawback of strategic asset allocation, SAA? A. It is too focused on short-term trends, B. It may underperform during an asset class boom, C. It doesn't involve enough risk, D. It results in an imbalanced portfolio. Answer, B. It may underperform during an asset class boom.